Hello everyone, welcome back to the course Financial Mathematics for Actuaries. In this week, we are briefly reviewing whatever we have learned from week 7 to week 11, and we are in the final day of the final week, and therefore today we will be briefly reviewing the yield curve and the term structure of interest rate, and also we will review the bond duration, that is the Macaulay duration, modified duration, and also convexity, and then we will stop. Okay, so let's begin now. Okay, so let's remember what you have understood in term structure of interest rate. What is meant by term structure of interest rates? Please recall that we have understood that bonds of different maturities have different interest rates, right? So the relationship between the short-term bond and the long-term bond, or put it differently, that the relationship among the interest rates or the yield on bond that are otherwise similar in the sense that they are similar risk structure, okay, but but have different maturities, then this is basically known as term structure of interest rate. Okay, so the difference between the short term bond yield and the long term bond yield will give us the spread, okay, or the premium, right? So the term structure reflects the market expectation of future interest rates, inflation, and monetary policy. What people expect the economy will be, right? Okay, in the near future. Okay, so it helps the investors to understand the bond market sentiment, okay, about the risk and the future direction of the interest rate, and therefore term structure and the yield curve analysis actually is very important for both the investor's perspective as well as the policy perspective, right? So it is a vital tool for economics and the investor to forecast economic growth and inflation, and also the, like, it is also useful for the risk management. Okay, so understanding the term structure and the risk structure and also the yield curves can also help you to better manage your risk of the bond investment. Okay, so let us now recall what is yield curve. Okay, so what is yield curve? It is just a plot of the yield on bonds with different term to maturity, but they have same risk, same liquidity, and the similar tax consideration. Okay, are basically known as the yield curve, right? Okay, so it describes the term structure of interest rate for a particular type of bond, for example, the government bond. Note that it is very difficult for, like, for us to find out a or different bonds having the same characteristics, okay, or the same risk structure, same liquidity structure, but you can think of some way the government bond is having the similar risk characteristic. They are mostly the default free bonds, and therefore we can consider the treasury bond or the government bond and explain the term structure of interest rate, okay, of this type of bond, right? That is the reason we have actually considered the treasury bond in our discussion, okay. But notice that uh, the yield curve simply means that it is a plot of the yield on bonds with different term to maturity, right? Okay, so we have also understood three types of yield curve, okay, that the normal yield curve or the upward sloping yield curve, okay, for which the long term interest rates are above the short term interest rates, or the long term interest rates are usually higher than the short term interest rate or the yield. Okay. We have also understood the inverted yield curve or the downward sloping yield curve. Okay. So it implies that the long term interest rates are below the short term interest rates. So when the yield curve is downward sloping, this means that long term interest rates or the long term yields are higher than, the long term interest rates are lower than the short term interest rate. Okay. But for upward sloping yield curve, the long term interest rates are higher than the short term interest rate. Okay. We have also understood a flat yield curve or the hump shape yield curve. Okay. So when yield curves are flat, basically the short term rate and the long term rates are actually similar. Okay. So that is the reason we are getting a horizontal curve. Okay. Right. So we have also discussed some of the term structure facts, right? What are the term structure facts? Remember that we can list it out in either way, but like let us remember the way we have listed it out. So these three stylized fact, why they are stylized fact? Because they are not, they are data driven, okay, or they are in fact the empirical observations, okay, repeatedly occur, and therefore it has been considered that they are indeed the fact. But okay, sometimes they can also be disproved, and that is the reason we can call it as stylized fact and not the actual fact. But sometimes like people also say that term structure facts, okay, without referring to the stylized term. Okay. So let us discuss the facts, okay, or the stylized facts about the term structure of interest rate. Okay, the first we have listed it that interest rates on short-term bonds and long-term bonds go together, okay, or move together over the time. So whenever short-term interest rates are expected to rise, then long-term interest rates will become high, okay, or increase, right? Okay. What is second one? Okay. Second one, like second stylized fact says that when short-term interest rates are low, the yield curve are more likely to have an upward slope. Okay. And when the short-term interest rates are high, the yield curve are more likely to slope downward and therefore can be inverted. Or very simply, we can also remember that, okay, this stylized fact also indicates that the short-term interest rates are more volatile than the long-term interest rate, okay, or the short-term yields are more volatile than the long-term yield, okay. The third one is the yield curve usually slopes upward, okay, meaning that long-term yield tend to be higher than the short-term yield, okay. So the long-term interest rate is always higher than the short-term interest rate, right? So these are the three stylized facts what we have discussed in our previous sessions, okay. And also we have discussed that there are several theories who came forward to explain this stylized fact, okay. So just recall what are the theories we have discussed. We have discussed the expectation theory first, right? The expectation theory actually based on what people think or what market participant think. It is based on the common logic, right? That's what we have discussed, okay. According to this theory, the long-term rates are the average of expected future short-term interest rate, okay. So the long-term interest rates are just the average of what people think, okay, over the period of time the short term interest rate would be, right. So when the short-term interest rates are low, people generally expect them to rise to some normal level in the future, right? And the average of the future expected short-term rates is high relative to the current short-term rate, right? Okay. So if the short-term rates are high, right, on the other hand, people usually expect them to come back down. Okay. What it says? It says that, okay, whenever people find that the current short-term rates are, like in a relatively low level, then in the near future they think that this short-term rate will be increasing. Okay. On the other side, okay, or on the other hand, if the short-term rates are found to be high today, then people think or people expect that in the, okay, over the time or after some period of time, okay, the short-term rate may be decline. Okay, it may come back down, right? And therefore, these theories, okay, which is based on the assumption of the bonds of different maturities are having the perfect substitutable, okay, it can explain the fact 1, okay, and fact 2, but it could not explain the fact 3, right? Another theory that tried to explain the stylized fact is the segmented market theory, or we will call market segmentation theory. This theory completely opposite of the expectation theory. Okay, while the expectation theory assumes that bonds of different maturities are perfectly substitute, okay, the segmented market theory does not believe so, and it says that they are not substitute at all. Okay, and therefore market for different maturities of bonds are completely separated and segmented. Okay, and the price of the bond determined based on the demand and supply of that particular market, right? So, and also it argues that the investors have short desired holding period and generally prefer bonds with shorter maturity that have less risk. Okay, so it says that most of the investors prefer to hold short term bond because they are free from risk, for example the interest rate risk and the default risk. Okay, and therefore this theory, you know, could explain the fact 3, but it could not explain the fact number 1 and 2 in our list. Okay, that's what we have discussed already. Another theory that tried to explain the term structure facts is the liquidity premium theory. This theory basically takes the idea of both expectation theory and the market segmentation theory, and then it tries to explain all the three facts, right? So this theory assumes that bonds of different maturities are perfect substitute, but they are not perfect or the bonds of different maturities are substitute, but they are not perfect substitutes, right? And this theory believes that because long term bonds are a relatively risky bonds, okay, the moment people want to hold this type of bond, they must be compensated for holding such bond. Okay, we will call it as a risk premium because they are taking like to take, okay, because they like to take more risk in the future, they should be compensated, okay, for taking such risk. Okay, and therefore we understood that most of the investors demand a premium to compensate for the higher risk associated with the long term bond. Okay, and therefore long term interest rates are usually higher than the short-term rates. Okay. So to encourage the investor to hold the less liquid long-term bond, a positive liquidity premium is added to the expected average, okay, of future short-term rate what we have calculated in the expectation theory. Okay, and because these terms increase with the maturity, the yield curve is usually slope upward. Okay, even if the interest rates are expected to remain firm. Okay, so even if the interest rates are expected to remain flat, right? So if the short-term interest rates are, you know, even if they are expected to remain the same, right? Because of the extra term or because of the liquidity premium term, the theory therefore, you know, explain that the long-term yield curve should be, like above the short-term yield curve, and therefore the yield curve should slope upward. Okay. Another theory that explains the term structure fact is the liquidity premium theory. So this theory assumes that bonds of different maturities are substitute but not perfectly substitutes. So this theory takes the idea of both expectation theories and the market segmentation theory and tries to explain the all three facts. Okay. So this theory argues that long-term interest rates are higher than short-term interest rate because investor demands a premium to compensate for the higher risk associated with long-term bond. Okay. So note that to encourage investors to hold this less liquid long-term bond, a positive liquidity premium is always added, okay, to the expected average of the future short-term rates the way we have computed in the expectation theory, right? And because this premium increase with the time to maturity, the yield curve is usually upward sloping, even if the interest rates are expected to remain flat. Okay. So this theory therefore could successfully explain the all term structure facts. Okay. So another theory which is known as the prepaid habitat theory, okay, that also combine the idea of expectation theory and the market segmentation theory and given the same conclusion as the liquidity premium theory. Okay, according to this preferred habitat theory, investors often prefer specific maturities rather than being different. Okay, but they can be moved to hold the long term interest rate given a higher compensation. Okay, so investor can be persuaded to move out of their habitat only if there is a higher compensating yield. Okay, often referred to as a preferred habitat premium. Right, if that is the case, then people can hold the long term bond also, but in that case the long term bond should give a higher yield than the short term bond. This is the reason the yield curve typically slopes upward. So both liquidity premium theory and the prepaid habitat theory explain that why yield curves should slope upward. Okay, that's what we have learned in the class, right? Okay, so how the yield curve has been seen as the forecasting tool of the economy. Remember that we have discussed that the yield curve can give us a better, like forecasting idea about the economy. Okay, by looking at the yield curve, one can predict where the economy is actually going. Okay, so a normal upward sloping yield curve suggests that economic expansion will be possible in the near future. Okay, while an inverted downward sloping curve often signals an impeding recessions. Okay, so whenever people find that the yield curve are upward sloping or steeply upward sloping, then most likely that the economy will move towards the expansion. Okay, an economic expansion can take place. Okay, also it will like suggest that in the near future inflation will be high. Okay, while an inverted downward sloping curve often signals an recession. Okay, so a steep yield curve predict a future increase in inflation, while a flat or downward sloping yield curve forecast a future decline in inflation, right? So, yield curve has been considered as one of the indicator of forecasting the future of the economy, right? Okay. So, let us now also recall, okay, what is the bond management or the bond risk management, in which we have learnt the Macaulay duration, the modified duration and convexity, okay, in the week 11, right? Okay, so please recall what is Macaulay duration, what it says. Basically, the Macaulay duration shows the average time until a bond pays back, okay, accounting for both interest payment as well as the principal amount, right? So, it is the weighted average time, mostly in years, okay, as investor must hold a bond until the present value of the bond's cash flow equal the amount paid, right? So, and we have also calculated the Macaulay duration using a formula, okay, which says that D is equal to sum of T time WT, right, where WT is simply the present value of the cash flow, okay, divided by P, right, sum of T time the present value of cash flow divided by P, right. So, we have also understood that, okay, the Macaulay duration acts as a direct indicator of the interest rate risk. So, a longer duration means that the bond price is more sensitive to interest rate fluctuations, right? So, the Macaulay duration gives us the bond sensitiveness of, okay, with respect to the interest rate of the bond, okay. So, another modification we have seen, okay, in the Macaulay duration, which is also known as the modified duration, okay. The modified duration measures a bond's price sensitiveness to interest rate change, representing the percentage price change for a 100 basis point or 1% shift in yield. Okay, so it tells us the price sensitiveness of the bond, okay, due to the change in the interest rate, right. So it is the risk management tool derived from the Macaulay duration that helps the investor estimate how much a bond's price will fall when the interest rate increase or vice versa, right. Okay, and we have computed the modified duration is equal to the Macaulay duration, okay, divided by 1 plus I. Here this I is like understood as the yield to maturity also, okay. Now, recall we have also introduced what is convexity. Okay, so while the bond duration provide a linear or the straight line estimation of how a bond's price changes with the interest rate, the convexity refines this estimate to account for the non-linearity, okay, or the curved reality, especially during large interest rate shifts. Remember that we have understood when there is a small changes or small interest rate fluctuation, then duration may help us, okay, but when there is a large fluctuation, then convexity is a better measure, right? So it measures the curvature in the relationship between bond prices and bond yield. So it measures how the duration of, okay, or how the duration itself changes as interest rate change, right? Remember that I have explained, or I have tried to explain it very simply, that like when the duration actually takes the first derivative of the price, okay, with respect to the interest rate, the convexity actually takes the second derivative, right? Or it tells us how the duration itself changes when there is a change in interest rate, right? So the formula we have understood was C is equal to 1 upon P d2P, okay, by di square, which is equal to 1 upon P summation of P square plus T Ct divided by 1 plus I to the power T plus 2. Here again this I is known as, okay, the yield to maturity or the yield, right? So, these are the very like very briefly we have just reviewed whatever we have understood, or whatever we have learned from week 7 to week 11, right? Okay. So I must tell you one thing, that I have sometime used some terms interchangeably. For example, like the effective interest rate, which is also known as the yield, okay, and the required rate or the required yield, okay, or the yield to maturity. Everything actually, like sometime I have written it I, sometime I have written it as YTM, and then while computing the yield to maturity, I have considered like the R there. So please don't confuse with this term, okay? Just try to understand what the formula says and what actually we are like learning, okay? I have also taught you the other ways of risk management, for example the diversification, and then I have also introduced to you the concept of diversification and the concept of how to create the portfolio, and also how to choose the optimal portfolio. I think uh, those things will be helpful for you. Let us close this session. I believe that we have discussed enough related topic that are helpful for the course financial mathematics for actuaries, and I believe it will be helpful for you also, and therefore thank you so much for giving me the opportunity to deal with this course. I wish all the best. Thank you so much guys. Do well.